Look, you just said a moment ago that they do look overseas. We've got to ask you about this Deutsche Bank story, because the Justice Department is hitting the bank with a $14 billion fine. This stems from the financial crisis, as you know, David, but it's the latest problem for this bank, and it's weighing on the European markets right now. How important should we be viewing the Deutsche Bank problems?
Yeah, I think that the Deutsche Bank problem itself is one of negotiation, and the Fed and the DOJ on this issue has negotiated settlements with all of the other banks, starting with a higher number. But the issue specifically for Deutsche Bank has to do with their reserves. The fact that they apparently have about $5.5 billion of euros, and given the size of that claim, that's not sufficient. So it's a significant matter for them, and obviously a significant matter for the regulators, and it is scary for the market.
Do you think this? I mean, listen, you've got instincts on this stuff. Just because you're a banker doesn't mean you necessarily know anything more about Deutsche Bank than any of us. I just want to get that out, because I know you're probably not going to like this question, but I mean, do you think Deutsche Bank would get taken out?
I don't have an opinion about that. I certainly think that Deutsche Bank is a linchpin for the European economic system, and having them be healthy, given their leading role in that economy, is going to be very important.
I think, if anything, Deutsche Bank would issue more cocoa bonds, which they did last time when they got in trouble. I mean,
it's a German jewel, right? So they probably wouldn't allow it. But it's really...
There would be lean knock-on effects.
But it's also especially postured by the Justice Department, starting out with a really high number, and then, eventually in those negotiations, as you're mentioning, going down.
You're exactly right. There have historically been these sort of negotiations, none so big and public in terms of the initial volley, however. It's an unusual response.
Look, I remember when the IMF said Deutsche Bank is the biggest risk to the financial system.
And that's because of their derivatives book, so they have a huge derivative exposure.
And it's also hitting Italian banks. I mean, the Italian banks. Look at this. So, I mean, how important is this issue for the Federal Reserve? You just said they look overseas. They've got to be focused on this.
Let me put the issue in this context. The work that was done in the U.S. to do bank reform, to recapitalize banks and have them get rid of bad assets, is probably 4 to 5 years ahead of where the Europeans are. However, the recent actions in regulation on the ECB has really propelled them to do much more, and it's clearly a major focus of what's going on in Europe. That said, by being a few years behind, they're at greater risk because of the stage we are in the economic recovery.
And don't forget what former Clinton Treasury Secretary Larry Summers said. He's saying this morning in an article that banks are no less riskier and may actually be more dangerous today, since the heavier regulation, than they were in 2008. I mean, that was...
Well,
a stunning statement from Larry Summers.
They talk so much about how they care about systemic risk, and they do these stress tests, and if the money is, they don't think it's adequate, they demand the banks not issue dividends and so forth, and yet they think nothing of pulling $14 billion out in a fine.
That is such a good point, James. You're right.
Those rules kind of go out the window when they want to go to the ATM and take more money to the government.
That's absolutely right.
To Larry Summers' comment, though, it's a knock-on effect of Dodd-Frank and all the regulations that have been imposed. But you've even seen a Fed official, Neil Kashkari, come in and say, he's even said that banks are too big now. Yeah. They're even more bigger than they were to fail before.
I don't think they're going to get broken up. But look, in the face of all of this, David Bailyn, you have to allocate capital, and you have to actually invest your clients' money. So tell us how you're allocating capital right now. What are you expecting for the next 12 months from markets?
Right. Although we've taken down the actual equity rate, the amount of equity that we have for clients, we're still well above our target. In other words, we're still more aggressive on equities than we are on fixed income. We've had movements into the emerging markets for the first time over the last 6 months, so we do believe the emerging markets, in particular in Brazil and other places in Latin America, are going to recover, and that's going to present an opportunity. We've seen low rates move to the emerging markets. If you take a look at Brazilian bonds, for example, in dollar terms, they've done extraordinarily well, indicating that people are regaining confidence there. When the emerging markets do that, it's a signal that people can expect continued growth in the developed markets as well, and overall economic health. So our clients are overweight, and as I mentioned, Maria, on break, one of the things that I'm seeing is that people are now investing post-August. They're actually putting more money to work. We're seeing net inflows in a way that we haven't for the last 3 or 4 months prior to the summer. So that, to me, indicates that people are really looking out the next 12 to 18 months and acting on our belief that, especially for wealthy clients, that this is a time for the next 12 to 18 months when we can expect more normalized markets and reasonable returns.
So tying this back to the possibility of an interest rate hike, a lot of banks are coming forward saying that these low interest rates are actually hurting their profit margins. What's your take from your perspective?
There's no doubt that the net interest income margin for banks is deeply impacted by these policies, and we're all obviously watching our expenses as a result of that. Nonetheless, nevertheless, our belief from a sort of strategic standpoint is that the Fed really doesn't have lots of options in terms of raising rates significantly. When they do, it'll be only because of this clear data. And so we expect a benign environment here, but we also expect a continued and long benign environment in Europe and in Japan.
By the way, if Donald Trump gets in and he pushes this 15% corporate tax rate, do you buy the market or sell it?
I really can't say.
Ah, David.
I will.
You're no fun. You can't say.
I think you're picking out one data point, which is like one of those things where, if economic policies are clearly favorable in terms of getting investment to really change, which I am skeptical about for both parties, then I can imagine wanting to buy the market.
All right, David Bailyn, good to see you.
You're welcome.
Thank you so much. David Bailyn from Citi's Private Bank. Kevin.